Do interest rates affect the property market? Question I get asked all the time. And it's something that I actually want to bring to someone's attention or your attention watching this video, because I want to show you and give you some evidence of times when interest rates have risen and have fallen and nothing has happened to or the opposite has happened to the property market than what people think. People think the property market's going to crash because they're going to raise the interest rate. And I don't think that's going to happen. It might slow down certain buyers' activity, but what we got to keep in mind that property is a big jigsaw piece puzzle. There's multiple things that influence the market. It's not just one thing. If it was just interest rates that influenced the market, then how come there was slowdowns in the market previous years when there was a drop in the market, and in all the other years they've gone past? So we've got to make an informed decision. It has to be calculated. It has to have evidence base, and we have to understand what influences the market. And this does have some effect, of course. Not saying it doesn't, but I'm saying that you have to look at things from a different world view, from different lenses. This is something important. You're going to learn a lot here because this is never spoken about. So what 99% of regular Aussies don't know is that there is a risk assessment. So if you're applying for a home loan, you're an investor or an owner-occupied, going for a property, the banks are going to do an assessment on you. They're going to stress test your personal situation and see, can you still cover that loan? Now, they're going to assess this at a principal and interest rate, not on an interest-only figure. So if you look at that, if they're buying a property, even if you're an investment and you're going interest only, they're going to stress test you at principal and interest, regardless if you're going interest only. What they're going to do, let's say you get an interest rate of 2.5% you're getting from your bank or broker. They're going to stress test that, and they're going to put it at 5.5% to 7%, depending on the individual. And they're going to compare that, and they're going to see, can you still afford to hold the property? They're not going to compare you from 2 to 4%, depending on the rate you're getting. They're going to compare you on a rate that's even. They're going to add another 2 to 3% on that. And they do that on purpose. Next thing they'll do, if the property is an investment property, what they're going to do is, if you're getting $100 a week rent, what they're going to do, they're going to shave off 20% and only include 80% of that rent. So if it's $100 a week, they shaved off 20 and they're only going to take 80 of it. It's $80 a week. So your cash flow of the property will actually decrease. Why they do that? Because I want to know if anything happens to the market, you can still service that property. Then the last thing is your home expenses. So your monthly expenses, you might give your expenses to your bank or accountant, bank or broker, and they might say your expenses are $2,000 a month, hypothetically, or maybe 3, or maybe 4, whatever it may be. But they're always going to add more on your monthly expenses because they want to stress test that. Now, Australia has a very strong economy, especially the housing market. If we look at the GFC back in 2008, the global financial crisis, when America collapsed, the property market collapsed because they were giving away ninja loans, which they call them, which is they were giving loans, not doing no stress tests. They didn't care who you were, what income you're making, where you lived, how you're going to pay off that property. They were just giving loans to any individual. Same goes in Europe and same goes in other countries across the world. And that's why there was a massive global recession at one point. But Australia didn't really cop it. Australia's property market actually, if anything, soared and just kept climbing. During those times in 2008, we've seen places like your mining towns went ballistic. We've seen some of the capital cities grow unbelievable growth, especially your Brisbane and your Perth markets. Now, of course, there were some markets that had a bit of a slowdown, but this is something to keep in mind. So APRA, at this point in time, they're announced, of course, they're going to put the minimum serving rate to 3% above. So, this is in the next 2 to 3 months. So rates they're gradually going to increase. It's not going to affect the property market dramatically and might slow down buyers' activity. But when there is some supply versus demand, and there's a whole bunch of other things influencing that market, interest rates are really the last thing on people's minds. So let's show you some evidence and something that you got to take and understand. So this graph is from CoreLogic, okay, and this is some of the price drops in these certain years. Now, This is something to take in consideration. All right, and see, this is nationwide. Now, if you look from the 90s, there was a negative 4.4%. Now, some of your big drops were 2008, negative 7.4%, 2010 to 12, 6.3% negative, and then, of course, 2017 to 19, a negative 8.4%. That was more your Melbourne and Sydney markets that really had a slowdown. Why these slowdowns came? There was a whole bunch of other things that involved. But these markets dropped in value. Now, your Melbourne and Sydney markets back in 2017 and 19, some of those markets dropped more than 15% in that time frame. Okay, so people think that those capital cities didn't. They actually did. They dropped in value. Some of those inner fringe suburbs. Back in 2008 and 9, there were some other markets that really, hemorrhaged and suffered, especially in 2010 and 12. Some of those mining towns, which you've probably heard of, collapsed. Okay, so this is something to take in consideration, and just look at some of the evidence. And I just want to show you some things here. So back in 2008, the GFC, the market dropped more than 7%. And if we look at the rate, it went from 7%, although at one point it was at 3%, and then it went to 3.75%. So if you look at that, from 2008 to 2010, it went from 7% basically to 3% or 3.5%, which is a massive drop. But the property market actually declined. In a lot of regions, it declined, and there was a lot of regions as well it actually performed quite well. But how come the whole nation didn't drop? And this is something where I want to be really specific and people understand, because every market's got different things that influence the market. And what I mean by that is property is a big jigsaw piece. There is multiple things like employment of people, jobs getting created. So in a particular market, movement of people moving from different places, that influences the market. Infrastructure projects, government policies, interest rates can be one of them, of course. Access to credit is another thing as well. And the list goes on and on and on. Supply versus demand, vacancy rates of properties on the market. There's a whole bunch of things that come into consideration. And so that's what has an influence on majority on the market than what interest rates would. So it's something to take in consideration, because when the interest rates did drop, there were markets that were still dropping in value. Okay, so it doesn't matter if they, you would think if interest rates are dropping, property markets are going to soar. But, when COVID hit, okay, interest rate did drop by a certain percentage, but that didn't influence the market for people to buy because of the interest rates. There was a lot more to it than that. So that's something to take in consideration. So if we look at 2017 and 19, 8% it dropped the market. Majority of those markets were the two big capital cities. Record low interest rates at this point in time. 1.5% went all the way to 1%. Record low interest rates before where we are now is record low. But of course, at this point in time, this was record low. Why this market actually slowed down? Why did it drop? Now, there was a Royal Commission, APRA came out, and they were tightening up lending, and they were making it very hard for investors to get access to credit, even homeowners. And then as well, what they were doing is they were going to remove negative gearing at this point in time. And people were scared, and they were thinking the market was going to drop. And if they did get rid of negative gearing, what was going to happen? Which people were going to suffer? The people that use negative gearing as a strategy to invest, because they're not going to get the concession. So this is a video just to show you and see that, interest rates have a very small effect on the market. Where is the market going? If interest rates rise, they do it in small incremental stages. Sometimes it can be a big drop, as you can see here. And this is the cash rate. Sometimes it can be a big drop in a certain amount of time. Sometimes it can be small incremental drop increases or decreases as well. So it's something to take into consideration, and not just think that the be all and end all is interest rates. Are the RBA, going to raise interest rates? Yes, probably they are. Is that something to worry about? Not necessarily, unless you're ready to get into the market. If you can afford to get into the market, why would you wait when there's other different influences in the market and they're seeing these massive price growth because of different things or multiple multitude of things influencing those markets. Are there markets to be cautious of? Yes, there are. Do you have to do due diligence? Yes, you do. But this is something to show you that interest rates are very, very small, minute of influence in the market. In 2000 and from 2000 to 2005, that was a nationwide boom. Okay, well, that was the biggest boom before this boom was that started in 2020. That was the biggest boom ever in Australian history. Now, when that boom happened, okay, from 2000 to 2005, there was 22 rate increases. 22 rate increases. By doing that, the property market did not slow down. If anything, the property market just kept soaring. We've seen places like some of your regional towns in Queensland, your Hobarts, and some of those towns on your coastal lines, like your Cox Harbour, your Byron Bays, some of those places on the east coast as well in Perth. Some of those places grew more than 100 to 150% in 5 years. But interest rates rose 22 times. But why didn't the market slow down? Because there's more things happening that were influencing the market. Something to take into consideration. And I say this because people, if they want to be fearful because of this, they could possibly miss out on one of the greatest opportunities to take advantage of where we are today. There's multiple things that influence the market. Something to take into consideration. And learn from this. This is something for some people to learn. Do their own research. Have a look at what happened. If we look at the 90s, the late 80s and early 90s, the property market in Australia, in Melbourne, dropped. Yeah, it decreased in value. And if you look at record high interest rates, they're at 17% in the late 90s. Late 80s, early 90s. 17% interest rates were at 17% at one point. Those interest rates dropped dramatically from the late 80s to mid 90s. Those interest rates dropped. During that period of time, the property market in Melbourne actually decreased. And then, of course, when it got closer towards the end of the 90s, you've seen a turn and a whirlwind started. Okay? So people got to take in consideration, there's a lot of things that influence the property market. War, Russia, Ukraine, that's not going to influence the market. Because if you look at back in 2001 in Australia, the nationwide boom, the biggest boom at that point in time ever in history, when the Twin Towers got bombed in 2001, the property market just soared as well. It just kept going up, didn't go down. So something to take in consideration, something to learn here. And it just makes you a better investor understanding this. This is something that's key to understanding about, risk management. And it's going to make you a better investor. So please share this video with other people that are fearful, that are scared, not sure. This will educate them. But the number one thing you want to take away from this, if you're ready to get into the market, you've got the money, you got the backing, the financial backing, take advantage of that. Make the right decision. Of course, calculated decision. Don't just go punt your money and put it down the drain. Make sure you get the right advice, get the right team around you. Because if you do not take action, you will probably miss on one of the greatest opportunities of a lifetime. So just remember that.